Welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. The market has seen a good run. Corporate earnings have been better than expected in the fourth quarter. Macro numbers are beginning to point towards green shoots quite visible in the economy. So as you analyze your equity portfolio, we thought it would be a good idea to talk about one equity product that usually gets left out: exchange-traded funds, or ETFs. Funds that are designed to mirror the returns of an underlying index and get traded on an exchange pretty much like a stock. Manas Shukla, who is the Vice President and Segment Head ETFs at Edelweiss Asset Management, joins me on the show this week to help us understand this investment instrument and the place that it might find in your portfolio. Manas, so welcome to the show. Thanks so much for joining in. So good times for the economy and for the market, at least in the recent past. I thought we'll start with some data just to put things in perspective. I was going through the numbers from the Association of Mutual Funds of India, and here's how the numbers stack up. So as of now, 45 total schemes, ETFs. These are not gold ETFs. Mind you, we're talking about ETFs beyond gold ETFs. So 45 such schemes prevalent. The total assets under management as of April 2016, 16,400 and roughly rounded off 16,400 crore rupees. Now contrast this, of course, with the equity AUMs, and the numbers are obviously staggering and very, very different, because total AUMs for equity funds as a whole is running well over 3,50,000 crore rupees. So not a new category, but a category that's yet to become very big and meaningful. Why should one look at ETFs?
Specifically talking about the product as such, ETF gives you the advantage of a mutual fund wrapped in a exchange platform. So effectively you get the benefits of a stock, as you rightly pointed out. Apart from that, it is a mutual fund. So underlying, there is an index. It's not just one security or 10 securities you're buying. The important element out here is that they actually are the most transparent investment option available on date. So whenever you are investing in an ETF, you exactly know the number of stocks which you are investing, what is the weight you are investing into, and that is what has caught on to across the world. Today we have roughly more than $3 trillion following ETFs.
Absolutely.
Right. So in India, yes, it's not taken off that well, primarily because of the reason that they've not been good indices overall. Number one. Number two is now that the new index providers and the new indices are coming up, we would have a lot more exchange traded funds. Apart from that, as most of my friends in the industry point out, that ETFs actually do not outperform most of the active fund management. Primary reason for that is the fact that ETFs actually mirror an index, and the index itself in India were the normal plain vanilla indices as such.
And even right now, a lot of the existing ETF products are centered around the Nifty, or maybe a couple of Sensex ETFs that we have ongoing. It's only now that we're seeing newer indices and ETFs which are mirroring these new indices.
Exactly. So what happens, it's basically an evolution curve. So we are getting into the next level of indexing as such, and ETFs, specifically speaking, are now coming up that curve.
So fair enough, ETFs are evolving, but I'll still ask you a very basic question. Why go in for an ETF? Why not go in for an index fund? Doesn't that pretty much do the same thing? That you are not trying to outperform the market, you're trying to be with the market and be with one particular index of the market.
Actually, there's a big difference between an index fund and an ETF. Though the objective of both is to actually replicate an index, but what happens in case of an index fund, the money flows actually accumulate into stocks at that same very moment, at that very price. So for example, for a Nifty basket today, the price for which one basket can be built is approximately 35-37 lakh rupees. Right. But if I get 2 lakh rupees, how do I allocate that? Right. Okay. So that is where ETFs actually have an advantage, that ETFs only create and redeem in creation unit size, which is one basket ideally. So at any point of time, any existing investor, I'm not giving credit of any existing money to any new investor, and I'm not giving any credit or debit of the existing redemptions to any of the existing investors, and that is where ETFs differentiate between a normal mutual fund, a normal index plan, and an ETF. So ETF is basically, you can say, like drawers in your cupboard. So one drawer, pull it out, it's there. I mean, you can pull it out, keep it separately. So it would not affect the remaining drawers.
And every unit will mirror the index. Every unit is an individual entity itself.
Exactly. Every creation unit is an index itself. Right. So what happens is you are getting into an index through a basket creation. Basket creation happens normally by large investors or the authorized participant market makers who do it for us. And once a retail investor is going ahead and buying it, he's buying it from the exchanges. So the creation which is happening is being done by the authorized participant or the market maker in one lot.
Okay.
So none of the existing investors is getting hampered because of it, and none of the new investors would have actually a say on it.
You mentioned exchange, and obviously we are talking about exchange traded funds. So a person can sell individual units, either one unit or multiple units at any point on an exchange. Can an individual also sell or buy from the AMC if that's the case, and what kind of sums of investment or money are we really talking about?
Exactly. I would come back to the same point. As I pointed out, in case of an ETF, it is a basket. So I have to create and redeem in the multiples of a basket. As I pointed out, Nifty is roughly 36 lakh rupees. That is the amount required to buy all those 50 securities. 51 today.
Stock.
51 today.
Yeah.
Including Tata Motors.
The DVR, yeah.
Right. 51 today in that same proportion and having a minimal difference in terms of fractions. So that is where I would require that kind of a basket. So at any point of time, if there is a creation directly from the AMC, it has to be in that multiple so that none of my existing investors are actually getting hampered because of any money flowing in and flowing out.
Okay.
Right. So that is the concept of creation directly from the AMC. SEBI, however, also has the option that in case there is not enough liquidity for the final investor, he can actually go to the AMC and ask for redemption but there are certain criteria. If they are not being met by the AMC, and then only can an investor go and buy.
Okay, so we are only just getting started. There's a lot more ground to cover when it comes to understanding ETFs. We'll take a break. We'll come right back and then talk about the difference between the two approaches, active investing and passive investing. If you're looking at adding ETFs to your portfolio, what should that allocation look like? After the break.